Welcome back to Investing Talk Podcast. We're getting right into the details today on a company that's really been making some serious waves in fintech. Our focus is Robinhood markets. We've had a lot of you asking, is this a good time to buy now? Is the run-up real? So that's what we're exploring. And hey, before we really jump in, just a quick reminder, please hit subscribe, like the show, leave a comment. It really helps us out. And yeah, if there's another company you want us to investigate like this, definitely let us know below.
Absolutely. And looking at the sources we've pulled together on Robinhood, it paints a picture of, well, a very different company than maybe even a year ago. What we're seeing is some powerful recent momentum, surprisingly strong fundamentals underneath, and quite a few upcoming catalysts that really deserve a close look.
Okay, let's unpack that, starting with the recent growth, because wow, those numbers are pretty eye-popping. Just in the last few months, platform assets hit $298 billion by the end of July. That's a 106% jump year over year. Signals massive user engagement, right? And maybe growing trust.
Yeah, that trust factor is key. But what's really interesting is that it's not just retail driving this anymore. There was a huge institutional milestone back in September 2025. Robinhood got added to the S&P 500.
Officially.
Right, the S&P 500 inclusion, that's definitely a sign of maturity. But maybe break down for our listeners, why is that specific inclusion such a game changer for a stock?
Sure. It really boils down to demand. Instant, kind of mandatory demand. So when a stock joins the S&P 500, all those massive index tracking funds, you know, the big ETFs and mutual funds, they have to buy the shares. It's part of the mandate. So this inclusion just triggers guaranteed buying, passive flows. It dramatically boosts visibility and institutional credibility almost overnight.
And we're seeing that credibility reflected in ownership, aren't we? The sources point out institutional ownership is now, what, 93.3%? That's huge. Almost all the available shares are held by these larger players. But here's a question, though. Does that much institutional holding stabilize things, or does it maybe risk becoming a crowded trade? You know, one that could unwind fast if sentiment shifts. That's a great point. It's a critical distinction. The sources seem to suggest this is more fundamental accumulation, not just speculative froth. Like, we saw some really specific kind of aggressive moves in the fourth quarter. Davenport & Co., for instance, boosted their holdings by over 500% in October. Just October. When you see firms making those kinds of high conviction plays, they're betting the momentum is real and sustainable, not just a blip.
Okay, so that institutional belief plus the analyst upgrades we saw, that definitely fueled the price action. Sources mentioned it hit a 12-month high around $154, partly driven by upgrades like Keefe, Bruyette, and Woods lifting their target, a clear shift in sentiment there.
Exactly. But, you know, to really justify that kind of price action long-term, you need the underlying strength. So let's shift gears a bit and look at the company's actual financial health, because the competitive moat they seem to be building, it looks like it's supported by some, frankly, jaw-dropping efficiency.
All right, walk us through those fundamentals then. Now that they've scaled up, what do the books actually look like? The income statement, balance sheet?
They look incredibly robust, actually. Trailing 12-month revenue hit $3.57 billion. And if you zoom into the most recent quarter, Q2 2025, revenue was up 45% year over year. That's nearly $1 billion, $989 million. That's serious scaling. But the metric that just jumps off the page, the one that really defines them now, it's efficiency. The sources highlight this net margin. It's an astounding 50.13%. Just think about that for a fintech company.
50%? Wow.
Net income for the trailing 12 months was $1.79 billion. And looking forward, analysts are forecasting EPS for the full year 2025 around $1.35. And importantly, those forecasts keep getting revised upwards.
Okay, a 50% net margin is, well, it's incredible. That immediately makes you wonder, what does that profitability allow them to do strategically? Does that give them firepower for, say, big acquisitions?
It absolutely does. And that's probably the crucial takeaway here from the financials. It's not just that they're basically debt-free, long-term debt is listed as NA in recent filings, but that huge margin translates directly into really strong free cash flow, which means, yeah, they can self-fund aggressive moves, innovation, global expansion, or, like you said, becoming a major consolidator, picking up smaller players without needing to leverage up.
That kind of flexibility is really powerful. So how do they keep their edge against the big established players? What's the core competitive advantage that's generating that kind of margin?
It seems to be a mix of their brand appeal and just continuous targeted innovation for that mobile first generation. Robinhood really dominates with younger demographics. The platform is just designed to be super user-friendly, fast, accessible. They broke ground with 247 trading and fractional shares, right? Those are foundational. But they haven't stood still. They keep launching these high-engagement products, things like joint accounts, retirement options, and these prediction markets, which have apparently seen over 4 billion contracts traded already. They make investing feel accessible, maybe even fun for some people. And that seems to translate into sticky engagement and likely lower costs to acquire customers. So the fundamentals look solid, high profitability, basically no debt. Does the stock chart reflect that same confidence? Let's pivot to the technicals. What are the charts saying as of, say, early October 2025? Yeah, the technical picture looks pretty textbook bullish right now. The price is kind of bouncing around the mid-140s. We're seeing pretty solid support established above $124, with the next resistance level up near that recent high, around $157.
And compared to the moving averages, the longer-term trend.
Well, that confirms the strength. It's trading significantly above its 50-day moving average, which is down around $115,
Right.
and way above the 200-day, which is sitting near $72.
Yeah.
When you're that far above those key averages, it usually means the market is really validating the underlying story. Strong uptrend. And another thing, the RSI, the Relative Strength Index, it's at 43.6, which is actually pretty conservative. It suggests there's still room for more buying, more upside, before things get technically overbought.
And the professionals seem to be catching on too. You mentioned the analyst upgrades earlier. The consensus rating seems to have shifted towards moderate buy or buy. Specifically, you've got Bank of America raising their target to $157 right at that resistance level. And Needham bumped theirs up to $145 too. The street is definitely adjusting expectations upwards, probably based on that margin story.
We should probably add one little wrinkle here, though, that kind of goes against the big institutional buying trend. It's insider activity. We haven't seen huge insider buying lately. But we did see a sale, noted in the sources the General Counsel sold about $3.7 million worth of stock in October.
Okay.
And now, it's not necessarily a red flag people sell for all sorts of personal reasons, but it's worth noting just because it contrasts a bit with that aggressive institutional accumulation we were just talking about.
Got it. Fair enough. Okay, so looking ahead now, what are the key triggers, the catalysts investors should really be watching over the next, say, 3 months? What could really move the needle here?
Well, the big one, the most immediate one, is the Q3 2025 earnings report. That's due around the end of October, maybe early November. This will be the first major report card since that S&P 500 inclusion. So analysts will be watching closely. They'll want to see sustained growth in active customers. And critically, if that 50% plus margin is holding up or even expanding, a beat there could be a major catalyst. And second, keep November 20th circled on the calendar. That's the S&P 500 ETF quarterly rebalance.
Ah, right. More mandatory buying potential.
Exactly. Because Robinhood is a recent addition, this event usually provides some technical buying support as those passive funds adjust their holdings to match the index weighting. So a bit of a technical tailwind, potentially.
Okay, those are the scheduled events. What about the less certain stuff? Any speculative rumors or potential announcements floating around that could spark some unexpected movement?
Yeah, the market chatter seems focused on a couple of big potential themes. Given that strong balance sheet we talked about, there's a lot of speculation about maybe international expansion or strategic partnerships, perhaps in crypto or more advanced retirement solutions.
That makes sense.
And we're also hearing some buzz about potential AI-driven trading tools, maybe launching sometime in 2026. Anything like that could really boost engagement further.
Those are definitely exciting possibilities. But, we always have to balance that with the risks. And the primary one, especially for fintech, remains the regulatory environment.
Yeah, regulatory risk is just, well, it's always there for these companies, isn't it?
Seems like it.
We're talking about potential changes to rules around order routing, new regulations for crypto, especially with things like prediction markets or just shifts in how retail trading is overseen in general. Management seems to have navigated it well so far, but a sudden tightening could definitely impact revenues.
And what about the speed of their innovation? You mentioned all those new products, 24/7 trading, prediction markets. Does that rapid pace itself carry risk? Like execution risk?
Absolutely. That's a big one. Execution risk is definitely high when you're moving that fast. They need really tight operational discipline. Platform reliability has to be rock solid. Any major outage or a glitch during a big product launch could seriously damage that customer trust they've worked hard to rebuild. And finally, just general market volatility. Big swings in crypto or the broader stock market can always impact their transaction revenues. That's just the nature of the business.
Okay, so pulling all these threads together, the strong growth, the S&P inclusion, the incredible margins, the technicals, but also the risks. What's the overall investment thesis here for Robinhood right now, based on everything we've looked at?
Well, synthesizing all that data, the strong balance sheet, the index inclusion, that robust growth, it really does suggest a highly bullish outlook overall. Our research sort of landed on a 9 out of 10 rating. It seems to justify considering an investment for maybe two reasons: potentially short-term trading around those upcoming earnings or news catalysts, and for longer-term compounding, banking on that market dominance solidifying further.
And this raises a really important question for you, the listener, to think about long term. Given that 50% net margin, that debt-free balance sheet, the ability to fund their own innovation, the crucial multi-year question isn't just about how they grow their current retail market share. It's more about, do they use that financial firepower to become a major fintech consolidator? Start acquiring smaller strategic placers. Or do they successfully unlock a much bigger market through aggressive global expansion, maybe pushing into international banking properly? That capacity for M&A and for unlocking a much larger total addressable market internationally, those are probably the key vectors for multi-year growth that might not be fully priced in yet. So keep an eye out for signals on those global ambitions in the coming quarters.
Great final thought. Well, thank you for joining us for this analysis of Robinhood markets. We really hope this is giving you the information you need to figure out if it fits into your own investment strategy.